Hello and welcome back to another week of your Mortgage Market Movers Weekly, where we are detailing everything that's going on in the macroeconomy to help you make better home buying decisions. This week's 30-year fix is sitting at a 6.67, which is slightly down from last week's 6.69. We do get inflation information next week, and this will definitely impact the U.S. 10-year yield, which recently made a new high but has since backed down. We're going to get into that, get into some of Fed predictions for the next Fed meeting, and then all else data related when we get on over to the chart. So let's get on over. The U.S. 10-year yield. As I said, the U.S. 10-year yield has made a new high, just barely though, right? So this is 4.748 is the high from today, August 18th. The previous high, and this is in, let's see, this is the previous high since January of 2025, so over a year. But the previous high was on Friday, July 31st at 4.747. So literally like 0.001 point higher. But, this is definitely something to be cautious of. Like, just look at how this has been climbing. This is not great. Definitely not good. The whole bond market is just not doing too hot. If we pull the bond market in here, let's see, here you go. We can look at this. Is this going to show me? Oh yeah, it's down here. The bond market is just not doing too hot. People are not buying bonds. And like we've been saying, this is because we just don't know about inflation right now. We'll get into it in a little bit, but CPI and PPI came in solid. Really, they were at expectations. But expectations now, that's not good enough to bring the U.S. 10-year yield down. We really need inflation to cool off. So we are getting some inflation information next week. We're getting PCE. This is the preferred inflation gauge for the Fed. So that could potentially help. But, if we had expectations for CPI and PPI, I don't know if PCE data is I'm just not super hopeful that is going to come in significantly better than expectations. But last time we looked at the yield, we drew this box, and back in 2025, when we got into this box, we came down pretty sharply. So this again happened in April of 24, and the peak of the box was touched in 2023. But really, every time we get in here, we come down. It can be prolonged for a little period of time, and that's what happened in 23. But then, we had a pretty sharp drop. So hopefully, we see that we don't stay in this box for too long. The worry is really like when we stay up in this box for a prolonged period of time. We're talking like months of being in this box. Each of these little candles is one day. So, like we touched the box, came down, came back in for 1, 2, 3, and then on the fourth day we dropped down. Over here, we just really touched the box. Over here, we stayed in a little bit longer, right? So when we got in like over here. So this is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. So over 2 weeks, probably closer to, 2.5 to 3 weeks of being in the box. We just don't want to have prolonged periods in here. Really, it'd be better to have a sharp impulse up and then down. If we're just kind of grinding away in this box, it just doesn't look too good. With this is really, in my opinion, going to be an inflation thing. We need an end to the conflict in Iran, and we need some certainty about what oil's doing. I think that oil has cooled off some, but it's the fluctuations are too much. The uncertainty within the market is too much. That is what is, also contributing to higher U.S. 10-year yields. When there's not too much certainty in the market, we can expect investors to be timid, with something like a bond where you're locking up your money. for 10 years, right? That's the 10-year bond. So we want to keep an eye on those things, but inflation and just more certainty in this market. Okay. So this week we had building permits, which came in better. That's good. More buildings being permitted to be built. But housing starts, not as good. That's bad. So, residential housing starts, just not great for beginning construction. But that doesn't necessarily mean that it is, that doesn't necessarily mean that that's for all housing, right? This is just new construction housing starts. Pending home sales. So this is the change in the number of homes under contract to be sold and still awaiting. This was not at the forecast, but it was better than previous. So previous it was negative 4.8. This is negative 2.3. So that's better. Still well below the 0.1 expectation. Let's see. FOMC meeting minutes can be interesting, but probably not too interesting. And then when we look at next week, we have new home sales. So we'll see how that's looking. We have PCE Wednesday, August 26th. That is an inflation metric, so we definitely want to keep close attention to that. GDP is good to look at too. Personal spending and personal income is good. People need money to buy homes. And let's see. This could potentially be market moving, the Jackson Hole Symposium. Oh, this is probably, I think, like Kevin Warsh speaking at this. And yeah, so it's, just it's going to be some economic policy talk. There's probably going to be, actually, you know what? I don't know if there's a Q&A to this. But anyway, that could potentially move the markets, so we want to keep an eye on that, and that's going to start Thursday, August 27th. The Fed probability of a rate hike came down. It was looking like a hike in September 16th. That's the next Fed meeting. And now that's still at a pause, which is good, right? But as we continuously talk about, the Fed does not determine the mortgage rate. We want to look at the U.S. 10-year. And this was probably because when we look at CPI and PPI over here, this was last week, August 12th and 13th, respectively. CPI came in at expectations, but it was up from previous. For core CPI month over month, core CPI year over year, still high, 2.5%, a little lower than previous, but I mean, that's still high. So it's just not great. Non-core 0.1. So, that was worse than previous, but still an expectation. And then CPI year over year non-core 3.4%. That's, this is high numbers. This is not good. This, we have inflation for sure. PPI, so on the producer side of things, is better. 0.2 for core and then 0% for month over month. But, it's still not great. It looks like producers weren't paying quite as much, but consumers were still, it was tough for consumers out there. And I guess this is a month-over-month read, and when we compare the month-over-month CPI, PPI, it's not too much of a difference, right? So this is 0.0, this is 0.1. So I guess it's really year-over-year where we're seeing that sticky inflation. And then the expectation for PCE, which is next week, I guess they don't, maybe that's just the website. That's weird. They usually have, yeah, they usually have the forecast up. I don't know. Maybe they just don't have it. Maybe I'm here too early. Well, we can see that the last read was 0.1%. So, we want to beat this 0.1%. That's the previous. I don't know what the forecast is going to be. But that's what we have. Like I said, the 30-year fix, 6.67, down from 6.69. We'll take what we can get. It's not great, but it's better than the 30-year fix climbing up. And that is all that I have for you this week. So if anyone has any questions or comments, definitely feel free to reach out to us at www.mortgagesbylindo.com or give us a call at 877-TEAM-MBL. Have a great week, everyone. Bye.